My next guest sees about a 12% increase in the S&P 500 by this time next year, but warns it won't be smooth sailing to get there. Joining me now is Warren Pies, co-founder and strategist at 314 Research. Warren, happy Friday. So a little interesting exchange between our Jim Cramer and President-elect Trump just a couple days ago. Take a listen to this.
When President Reagan was here, he talked about putting the bear into hibernation, letting the bull run free.
Yeah.
Sound like a good motto?
Sounds perfect. I can't do any better than that. That's what we're going to do.
Okay, 2025, Warren, the market's going to be in a far different place than 40 years ago, 1985, when Reagan said that. The market basically ran for a couple of years after that statement of his into Black Monday. So is Trump's version of Reaganomics, you think, going to work on stocks here?
Yeah, thank you for having me. And I do. I think it's going to work. Obviously, there's major differences between the two eras, but the general feeling of having a president in the White House who is keeping tabs on the stock market and would go down and ring the bell. I mean, I do think it's going to work. That was the title of our research report, was that letting the bull run free, our 2025 outlook. And so, yeah, I don't think it's going to be necessarily because of Trump, but it's good to have an administration that's not going to get in the stock market's way at the very least.
So why do you think stocks stumble in the first half of 25?
Yeah, I mean, we still think that the soft landing is intact. That was our call last year. And I would say, when you zoom out from a big macro perspective, there's always, I'd say, two big risks: inflation or growth. And last year, we were more worried about inflation not coming down fast enough to allow for the Fed to cut. Whereas next year, I think that the bigger risk is growth. I think that we're going to have another growth scare. It's going to emanate from the housing market. That's going to probably be in, it's really difficult to pinpoint, but late Q1, early Q2. And that's going to put the spotlight back on the Fed. I think there are a lot of people like your last guest who are worried about inflation and thinking the Fed's about done with cuts. And I think the Fed's going to have to cut more. And there's going to be a little bit of pain in that process. But ultimately, I think the Fed will cut more than the consensus expects. And the soft landing continues, and we end up with a double-digit gain next year.
Okay, so you didn't think that inflation would come down enough for the Fed to cut. Some would argue that it didn't, and they cut anyway. What's going to change?
Yeah, well, I think number one, on the inflation side, the three big vectors of inflation that have infected the economy are all fading. So shelter disinflation, something we've watched for a long time, is going to roll over hard by our calculation early next year. So that's been the big holdup for CPI, something the Fed's been waiting for. So that's going to happen. A lot of people look at the 1970s and see a second wave of inflation, and that required a massive disruption to the oil market. We had 4 million barrels a day go offline into the second wave of the 1970s. This time around, we have OPEC adding back over 2 million barrels over the course of 18 months. So totally different oil market. I don't see any pressure from oil. And then finally, labor market's weakening. Less than 60% of total industries are growing payrolls at this point in the cycle. And that's honestly a recessionary level. And when you look down at the leading industries, we look at the housing market, for instance, and residential construction payrolls, everything we see is looking like the labor market is weakening. So I don't think there's going to be any inflation from those three areas.
If you're wrong about 2025 being up 12%, what's the factor you think that's going to hinge on?
I think it's going to be, so the Fed is trying to rehawk right now a little bit. I think they're trying to pause and trying to, say, let's see what happened with these last few cuts. Again, I think that the growth scare is going to hit very similar to what we saw coming in the summer of last year, where the Fed chose not to cut in July and then had to do 50 basis points in September to kind of support the market. The big risk is the Fed sits on its hands too long, and that maybe they, for some reason, whether it's political pressure or inflation or whatever in the data, and they sit too long and don't cut aggressively enough to bring down longer term rates like mortgage rates. We think you need to see mortgage rates get back down to like 6%. And that's going to take probably 100 basis points of Fed cuts next year to do that. I still think it's going to happen, but it's going to take some aggressive action from the Fed to keep the soft landing going.